Hello, good afternoon, and good morning, depending on where you are. I'm Jerry Theodoru, Director of the R Street Institute's Finance, Insurance, and Trade Program. Thank you for joining our R Street Insurance Forum series today. Our presentation is on the use or the prohibition against the use of credit-based insurance scores in personal lines, rate making, and underwriting. Our focus is on private passenger automobile. This is a subject that's getting a lot of attention, both in state legislatures and among regulators, certainly in the insurance industry and with consumer watchdog organizations, where there are arguments presented that advance the thought that the use of credit-based insurance scores may be discriminatory. So I'm delighted today to have with us two of the nation's leading lights on this subject that can help us explore and analyze the issues. One was present at the creation in the 1990s when credit-based insurance scores were first developed and introduced in the industry. And our other speaker is a distinguished actuary who's done excellent research for years on this subject, testimony, presentations. So I'm delighted that we have our two speakers with us, and I'll introduce them briefly. Maury Katz leads the legacy practice at reinsurance broker BMS Re. Prior to BMS, Maury was the president and CEO of Direct Response Corporation, the holding company for a group of direct response automobile insurers. But importantly for today's discussion, in the 1990s, Maury was at TransUnion, where he led a startup insurance vertical that performed a leading role in implementing the concept and the practice of using credit as a tool for insurance marketing and underwriting. Thank you, Maury, for being with us today. Roosevelt Mosley is a consulting actuary and a principal at Pinnacle Actuarial Resources. Roosevelt is a fellow of the Casualty Actuarial Society, and important to today's discussion is the fact that Roosevelt is the co-author of a recent, just released 2 weeks ago, Casualty Actuarial Society paper. His title is Methods for Quantifying Discriminatory Effects on Protected Classes in Insurance. Now, that paper is found on the Casualty Actuarial Society website. Roosevelt started his career at State Farm 32 years ago, but he sure doesn't look it. And I mentioned that this paper, Roosevelt's paper, is on the Casualty Actuarial website. And if you go there, it's in the Publications and Research tab, and under there in the Research tab, and under there in the Race and Insurance Pricing series. Now, many of you may not regularly browse actuarial websites for your leisure reading material, but in this case, I recommend it. It's an excellent paper. Thank you, Roosevelt. Congratulations on it. And there was another paper in the same series that came out a couple of weeks ago that also looked at potential discriminatory activity in banks and in bank lending. And today is an important day because two more papers will come out in that series in the CAS website. So something to dig into if you'd like. So let's go step into our time machine and go back about 30 or 32 years, back to the 1990s. And when Maury was there, as I mentioned, present at the creation, and can tell us in a few minutes a little bit about the history of how credit-based insurance scores were developed and introduced. Maury?
Well, thanks, Jerry. And I'm very happy to be on this panel with Roosevelt and you, and the chance to talk to all of the people who have joined us today. So it's a big thrill for me. And it's great to look back at those days. It's hard for people, I think, to remember that there was a time when credit wasn't used at all in insurance. It wasn't used for underwriting or pricing or marketing. And we'll take you back to 1993. And it was actually around 1993 that I joined TransUnion. And that happened, and I don't think totally coincidentally, corresponded to when Fair Isaac Corporation released their first insurance score. So basically, what Fair Isaac and what TransUnion were looking for at the time was a way to implement new products and to get better pricing. And it was a vertical integration to take what was going on in banks and move it over to the insurance industry. From the insurer's side, insurance companies were very keen to have a new pricing variable. And I think one of the things that people need to understand is that the ability to price and underwrite is a competitive advantage in insurance. And it's not about excluding people. It's about finding people that are properly priced for the real risk that they represent. Insurers actually want as many properly priced risks as they can possibly find, because that's the real business that they're in. And having new pricing tools does that. So once the credit score was out there, and once insurance companies expressed an interest in having it and using it for pricing, we went out and we did a retrospective analysis. What we did is we went to companies and we said, give us your claims data from 3 years ago, and we'll tell you, we'll pull the credit file for everybody that you wrote 3 years ago, and we'll tell you now what we could have told you then. And we'll compare that to actual losses and to loss ratio. And it came back after quite a bit of time and quite a bit of analysis as extremely predictive from a mathematical standpoint. And from then, the race was on for companies to figure out how to use it and how to price it, and for the regulators to make sure that they do what they do best, which is make sure it was fairly applied and followed all of the regulations and statutes that are out there at the state level.
Right. And since that time, I think I read somewhere that about 85% of personal lines insurers jumped on the bandwagon and were using them because of their predictive power. So let's talk a little bit about why they might be predictive, why they're so strongly correlated with the potential or the probability, the propensity for future losses. Roosevelt, can you shed some light or share your thoughts on why it could be that credit-based insurance scores are highly predictive of future losses, personal lines losses, automobile?
Thank you, Jerry. Happy to be on the meeting with you today and with Maury. Appreciate the invitation. And I will say, as an introductory comment, I've been at this for a while, and I know the gray hairs and beard show it. Not quite 32 years, though, so you added a few years to my resume. I try to get older before my time. To maybe build a little bit off what Maury said, just to put some of it in context, when he talked about the race being on for companies to implement it, that was around the time that I really began my consulting career. And so I very quickly got swept up in that race and was involved in a number of those retrospective type analyses that Maury was describing to help companies implement credit scores. And as part of that, also was involved with a number of regulatory discussions on the use of credit and the appropriateness of the use of credit. And over the years, there have been a number of theories, a number of reasons put forth as to why credit-based insurance scores were predictive of losses. And you probably know many of them as well as I do: personal responsibility, risk-taking behavior, those kinds of things. But really, there were sort of two things that I've seen over the years that I think really at least shine some light or shed some unique insight on this particular issue. The first was actually in a research paper written by Patrick Brockett and Linda Golden. And this paper actually goes back, I want to say, to the mid-2000s, but it's a paper, and I'm going to get the title wrong, but it's essentially biological and psychobehavioral correlates of credit score and auto insurance losses. And essentially what they did is they went through almost a biological or psycho behavioral discussion of why insurance losses happen, and went through a separate discussion on why credit score works in general, and then really kind of correlated the two. And it really shed some, I think, unique insight onto why similar types of behavior that drive insurance claims also drive the level of credit scores. And so I would commend that paper to any of the folks on the call as a really interesting read. The second piece of that's come out really in more recent history has come out as part of a lot of the discussion that's been having in regulatory and legislative circles about the use of credit-based insurance scores. And there have been some interesting information that have been released at a high level that really show some really striking correlations between credit-based insurance scores and specific drivers of usage-based insurance losses. So things like hard braking, uh, things like that, where there's no real argument that risky behaviors like hard braking lead to higher losses, but to see that things like hard braking also correlate to lower credit-based insurance scores really, again, kind of underlies the fact that there's something underneath that's going on there, but that they are truly drivers of losses. So I think the question is still out in terms of exactly why, and no one's definitively been able to answer that. But there's some really good theories and really some really good research out there that has been done to try and answer that question.
Yeah, thanks, Roosevelt. And then since you are talking about some of the bibliography, there has been a lot of material written about that. And if I can add on to that, not in the behavioral or psychological area, but more in the insurance area for those that are interested. One of the seminal studies that looked into this issue was in 2007. The Federal Trade Commission, the FTC, did a study on this, and that study continues to be sort of the source that's looked to, because it was very thoroughly researched, and it concluded that the use of credit-based insurance scores was not discriminatory. So that's an important point about the FTC report. And since that time, there was a study done by the Fed. The Federal Reserve did a study as well, and some states. Texas did an excellent study. Missouri also is one that's referenced a lot. Other states have done it as well. And more recently, Tony Cotto did a good presentation and good testimony on the subject. Lars Powell did a paper a couple of years ago in the Journal of Insurance Regulation. So there's lots of papers that are out there, and a lot of them also include the bibliography. So there's more than enough stuff to read there. And thanks for talking about risky behavior, because that's something that comes up a lot as a potential. Now, the term disparate impact is used a lot in these discussions. Maury, you want to comment on what is meant by disparate impact for those that are out there that aren't steeped in this subject as some others?
Well, on the other topic, I would say that it's very important that we understand why it works, and there's been a lot of theories, but in the beginning, all we really had was to talk to insurance professionals, and basically what they told us was that they look for stability in insurance and car insurance, and that you can see stability factors in the credit score. And whether or not that's right or wrong came later, right? And now we have the mathematical studies. So disparate impact basically just means that if use of any rating variable affects a group of any particular characteristics more than others, that has to be explained, and it has to be evaluated in the context of regulation to make sure that it's fair.
Right.
And from the very beginning, that was an issue with credit. And what's really funny is that, there's really nothing new under the sun. A lot of the things that we're talking about today were things that Fair Isaac and the credit bureaus were dealing with many, many years ago.
Yeah, these things have come up quite a bit over the years. We've seen them. And another term that has also come up and is used a lot, and it related to that, is a proxy variable. Mm-hmm. So there was the argument presented that credit-based insurance score is a proxy for race, and whereas discriminating on the basis of race is not allowed, it's prohibited. Finding a proxy variable which takes you to race is another way of doing it. Roosevelt, do you have any thoughts on what are proxy variables, and whether credit-based insurance scores can be thought of in that category?
Well, just more broadly speaking, and I'll zero in and answer that question. More broadly speaking, one of the challenges in a lot of these discussions are exactly what's defined, or how things are defined, how particular topics and words are defined. Because if you, depending on who you talk to, you'll get different definitions of things like disparate impact or proxy discrimination. And to reference back to one of the papers that's being released today by the CAS actually does a good job of walking through how those terms have been used historically, and how, depending on who maybe uses some of those terms, what's meant by them. But more specifically to the question of what's a proxy or not, from a purely statistical standpoint, a proxy is something that just simply stands in for something else. And so we're prohibited by statute, by regulation, by law from using things like race. But the question of a proxy is, are there other things that we potentially use in insurance to get at race, even though we can't use race? And that's the idea of a proxy. And so there are certainly things that we have discussed over the years that have been at least some contend that stand in as proxies. One of the things that I think is occurring now in a lot of these regulatory discussions is the realization that while a lot of these contentions have been made, there hasn't been at least a truly definitive answer to that question. The FTC study probably got closest, and I think did a lot to allay the fears that credit-based insurance scores were standing in as a proxy for race. They didn't even come close to finding or concluding that. But the broader question of a proxy, I think, is one that's now being, at least processes are being put in place to be answered by states like Colorado and others that are trying to address this issue. So there are, again, questions that still, I think, are going to be answered, but it's certainly an area that's getting a lot of discussion.
So just to come back to that a little bit, I think it's important to understand sort of how insurance pricing works and what insurance companies are really looking for with insurance pricing. So if you look at any variable, and what I think a lot of people do sometimes, they make a distinction between variables that sound like they're more intuitively connected to driving behavior or loss behavior, and other variables that may not be. So besides credit, there's been debate over the years about education, about occupation as rating variables, which are allowed in certain places and not in other places, and are in use actually by some of the big companies. But any variable is a way of defining risk, and within that variable, there's a distribution of losses, of loss ratio. So when you say that a particular variable like credit predicts a certain amount of loss, you're really talking about the average or the mean for that variable, which means there's tails on either side. So really the skill in car insurance is to be able to find people who are better than the variables tell you they are. That's why new pricing tools are so valuable, as credit was in the early 90s, because everybody was using motor vehicle record and gender and age and zip code. And then when you could go into those variables and you could find another way to discriminate that risk, in order not unfairly discriminate, but just say based on the risk of that person for claims and losses, it actually gives you a tool to accept more people. Because what you're able to do then is you're able to say, because credit is individual level, because it's continuously updated, and because it's completely behaviorally objective, you can say, okay, there's people in this zip code, and on average, they may have this particular loss ratio, but we can find people who were charging more than we should because there's another variable that's predictive and says they're better than that. So I think kind of turning the thinking around a little bit is that what people are really trying to do is accept more people. They're trying to find ways to find insureds that they can price appropriately and still attract them to the company. And that's really what insurance is all about. It's about properly pricing risk. And the other thing I would say is that credit and any of these other variables are tools. And like any other tool, they can be misused. I mean, you can hammer a nail or you can hit somebody in the head with a hammer, right? And I think that the job of the regulator, and they do it very well, is to figure out when it's being used properly and when it's not being used properly. And I think that's really the secret. And I think state regulation in this country is fantastic. And I think that they do a good job.
Yeah. And where you say that it's one tool, there was a time when there were very few data elements that were used, like MVRs, motor vehicle records, records of accidents. But you had some companies that would look for other sort of data elements and data that had predictive value. And then about 10 years ago, we got into the field of big data. So some of the insurance companies that had more sophisticated rate-making algorithms, I throw out Progressive, for example, we got really granular, looked at about 300 variables in order to have more accurate estimation and of the risk. And their results, I think, stand out in the industry is better than the competition, because they do get closer to the truth and they're not relying on one variable.
Well, and actually, I remember that because I actually sold them that data. But what was interesting about Progressive is that when the other companies were trying to buy the Fair Isaac insurance score, Progressive actually bought the variables. And there are, when you look at a credit score, or you look at a credit report,
Right.
you see a certain thing, but behind that are hundreds of variables. And I think that's a really good point, because you can really get closer to the true risk.
And they created their own algorithms. Use
That's
that.
right.
Yeah, they took the subcomponents and they put them together themselves. Yeah, I
That's
saw
right.
that.
Arguably that gave them a 10-year competitive advantage.
Yeah. And look at the history of Peter Lewis.
Yep.
Yeah. Right. And then Roosevelt, you mentioned about laws in place too. In most states, there are laws in the statutes relating to insurance that require that insurance company rates not be inadequate, not be excessive, and here, importantly, not be unfairly discriminatory. And also in your world, Roosevelt, I think the actuarial standard of practice says something very similar. So you have these prohibition, this restriction on the discriminatory practice. It's been there. Certainly the statutes have been there for quite a while. And I imagine that the actuarial standards of practice have also been there a while. But why is it then? Well, why do we think then that now it's been heating up more, if these issues, as we've discussed, have been around for a couple of 3 decades or more, and statute has been pretty clear on rates not being discriminatory? Why has this become a real hot button item? We've seen developments, activity in Washington State and Colorado, and recently in Maryland and other states as well. Why now? Roosevelt, do you have any thoughts on the spirit of the times?
Yeah, sure. There's an awful lot in that question, and so I'll try to be succinct in my answer. First, in terms of the statutes and the actuarial standard of actually statement of principles that says rates have to be basically not inadequate, not excessive, and not unfairly discriminatory. The word unfairly discriminatory, and I'll refer you back to the paper that's being released today, because it does a really good job of kind of tearing apart that term. But unfairly discriminatory in pretty much all cases, as it relates to actuarial standards, doesn't really mean discriminatory in terms of the social sense of discrimination. It's more discriminatory in terms of separating risks based on their propensity for loss. And so for a rate to be not unfairly discriminatory simply means that I can support the difference in rates by age, or by credit-based insurance score, or by territory based on the loss experience. And so again, in actuarial lore, as long as I can do that, then the rate is not unfairly discriminatory. So it does create some confusion when you're talking to folks outside of the insurance industry, because they hear not unfairly discriminatory, and what they hear is more of the social sense of discrimination, and making sure rates aren't discriminatory from that perspective. So in terms of why it's getting so much more attention, it seems like today, if you were really paying attention before 2020, these issues have really been coming up repeatedly for as long as I can remember. So the issue's always been there. The questions have always been there. No secret that what happened in the summer of 2020 really was a reckoning in this country, and there were a lot of areas within our nation that got some increased scrutiny because of our history, and insurance was no exception to that. And I think what happened in 2020, a lot of things came out of that really had already been started to a certain extent, just began to be elevated in terms of their focus. And so the NAIC formed a special committee, INCOIL, the National Council of Insurance Legislators, formed a subcommittee, a special committee to look at this issue. And out of that have come a number of things that are still in development. Legislators also began taking up this issue, and I mentioned Colorado earlier. To date, Colorado's probably passed the most substantial legislation related to this issue that we're still working through exactly how it's going to be implemented. So the summer of 2020 definitely had an impact on why there's much more focus on this issue now, but these issues had been building really for years.
Yeah, and Jerry, one thing that I found very interesting along the way, and Roosevelt's absolutely right, this is all the way back to the very beginning, is that there's not as much scrutiny on other variables. So think about the motor vehicle report, which is the most intuitively obvious. When you ask the question, what does my X have to do with my losses or my driving or my claims? Nothing could be closer than a motor vehicle report. But a motor vehicle report varies by state. Certain things are accessible in some states, certain things aren't. Coverage areas are not as good as credit. And if you think about it, some people have the wherewithal to reduce a ticket or to eliminate a ticket, and other people don't. So there's discriminatory aspects, and maybe even in the social sense, to almost every variable. But I think an interesting area of this field is why credit gets so much. And it always kind of puzzled me, because nothing could be closer to the real individual than credit itself, because it refers directly. And I think that one of the studies of interest is that it probably allows many, many people to get a better rate than they would otherwise. But the focus seems to be on when people get a worse rate than they would otherwise.
Right. Yeah. But we got a few minutes remaining. If you have questions, put them into the chat box, question and answer, and I'll try to take them. But in the meantime, I just wanted to mention that our speakers are speaking in their private capacity, do not represent the views of their employers. And also, Roosevelt, the papers that you talked about, there's 2 coming out today. Do you want to say a couple of words about what the Casualty Actuarial Society has been doing in this area from your perch there and your role? I know you were the co-author of one of the papers, and one of the things I liked about your co-authored paper was it goes into the ancient history when the insurance industry did do redlining, and I had never seen a map of Chicago that was actually colored in red from the 1930s. So that was pretty instructive to me.
Sure. And so just again, at a high level, a lot of the discussion around the idea of whether rates are fair or not, that discussion is not going away. It's only intensifying. And obviously, because actuaries and a lot of insurance companies are responsible for setting rates, if it only makes sense that we are an active part of those discussions. This will be a collective effort between all parties involved to get to whatever the solution is. But actuaries have to be involved in that effort. And so what we wanted to do at the CAS was really to commission research that would allow actuaries to become better educated about the issue, to become more involved in the issue, and to really be able to add their voice to a really difficult and a really challenging issue. And so that's what the CAS has started with this paper series, and certainly will continue as this issue continues to be researched and continues to be discussed.
Right, thank you. Yeah, well, we've come up against the time. A couple of questions are are coming in, but we'll get back to you with those. So at this point, I want to thank our speakers. Thank you, Roosevelt. Thank you, Maury, for joining us today and sharing your great insights, wisdom, analysis. And as you say, Roosevelt, this is more to come. So we'll stay on top of this. And thank you all out there for joining us at this R Street Insurance Forum presentation today. Thank you and good afternoon.
Thank you.
Thank you.